Hey guys, welcome back to the Investors Podcast new YouTube mini-series where I'll break down our ultimate guide to stock investing to teach you the best tactics for building wealth over time. Hi, I'm Shawn, and this channel is all about the principles of investing, from stock tips to iconic billionaires, the best strategies, and our favorite tools. The Investors Podcast has everything you need to know. In this third and final video, we'll explore how to actually buy a stock step by step, how to monitor your investment portfolio and effectively rebalance, and summarize our learning from the whole series. If you haven't watched the other two videos yet, make sure to go back and check out those lessons first. All right, let's get started. For those planning on picking stocks, index funds, or other securities, let's go through what that process may look like. First, you'll want to select a broker, and some of our favorites are Charles Schwab, Fidelity, Ally, and M1 Finance. There are so many great brokers today, though don't waste too much time on this as a beginner. Compare websites and apps, see if any speak to you, and ensure that they're compatible with your bank. To get set up, you'll need a valid email address, social security number, and bank account info. Next, you'll need to choose the type of account to open. We discussed this in detail in our second video in this series, but your main options are choosing between a taxable brokerage account, an individual retirement account, or both. Once your account is approved and open, you'll want to start funding it with cash. Some brokers will let you upload paychecks directly or link your bank account for easy transfers. But either way, you'll need some money before you can make any initial investments. The fourth step is to use our guide to aid in picking your first stocks or ETFs that have unique short identifiers known as tickers. Apple, maker of the iPhone, has the following ticker, AAPL. You can easily Google a stock's ticker, or sometimes searching the company's name on your brokerage's platform will allow you to find the stock as well. With an investment selected, you can then specify the number of shares you'd like to purchase, or if your broker offers fractional shares, you can just input the dollar amount you'd like to invest. There may also be order type options as well, but beginners will just want to keep it simple and select market order. There you go, you're ready to purchase stocks. It's as simple as that. As you build out your investments, you'll certainly be tempted to track their performance, and this is important to do intermittently. The trick is to moderate your eagerness. In building wealth, the tortoise really does beat the hare. Investing is a slow process built around a long-term mindset. Studies show that counterintuitively, investors who check their portfolios the least, beyond a necessary threshold of course, actually perform far better than their more zealous counterparts. This is because successful investing has more to do with temperament than wit, as the patient investor will be rewarded in due time. Staying in the game the longest is what matters for compounding, and the most active investors among us also have the highest propensity to commit sins that divorce themselves from their long-term goals. For a responsible and diversified investor, rebalancing is a vital aspect of your financial management that'll require an occasional review of your investments. If you use a robo-advisor or a financial advisor, they'll manage this part for you. For those hoping to manage a basic investment plan without the fees of any advisors, let's go through an example. Say you hold a portfolio with an index fund for large US stocks, that's 40% of your allocation, another fund for small and medium stocks, that's 20%, 15% in a real estate fund, and 15% for international stocks, and 10% for emerging market stocks. This is your set allocation to start, but over time, as some investments do better or worse than others, they'll make up a different percentage allocation of your portfolio. If your real estate ETF has an exceptional year while your emerging market ETF doesn't, you could see your real estate investment now comprise 18% of your portfolio, while the emerging market investment falls to 7%. To reap diversification's full benefits, rebalancing is necessary. You'd either sell a bit of the real estate fund and use the proceeds to purchase more of the emerging market fund, or you could generally contribute more to the stock funds that have become a smaller slice of the pie than intended. If all this rebalancing seems tedious, difficult, or just plain confusing, services like M1 Finance can help you to manage rebalancing automatically. For those opting to rebalance themselves, this should be a once-a-year activity, not something to try and manage every week. You'll end up spending a lot of time and stress doing this and risk incurring taxes if in a regular brokerage account to little benefit. Pick a day every year and make a habit of rigorously reviewing your investment strategy on that date and rebalancing accordingly. Even if you're not the one rebalancing directly, an annual review is still a useful exercise, but any more frequently than that becomes increasingly unnecessary. Another major variable for investing is paying taxes. In regular brokerage accounts, you'll be taxed on capital gains whenever you sell a stock above what you paid for it, and on dividend income paid out to you as a shareholder. Your broker should make this process quite painless though, as they'll track your cost basis and dividends accrued, in addition to providing the relevant tax forms. Depending on how long you hold your investment before selling, you'll be taxed differently on these profits, with the most favorable rates applied to investments held for over a year. These are called long-term capital gains, and for the vast majority of investors, they'll be taxed at 15%. The government also disincentivizes short-term trading and speculation by taxing gains on investments held for less than a year as ordinary income, which tends to be significantly more costly. So if you do make large profits, if possible, actually try and wait 1 year before selling. And if you ended up losing money investing in a year, you can use those losses to offset taxes owed on your regular income. As we know, the stock market is an incredibly powerful tool, and one can utilize our free and open financial market system to collect ownership in the best companies globally while saving towards a variety of goals. Although many of the details touched on in this video series have more nuance associated with them, this is an excellent starting point to begin your lifelong journey in building wealth through savvy and pragmatic investing. With a little work, patience, and willingness to learn, you can leverage stock ownership and tax advantage accounts to tremendous personal gain without needing a genius level IQ or Wall Street salesman. Check out the Investors Podcast Network's educational resources below for the full guide and our other learning tools. And as Warren Buffett says, don't ever forget, your best investment is yourself. There's nothing that compares to it. That's it for this mini-series, guys. Thanks for watching, and let us know down in the comments what you learned. What type of tools you use to manage your investments, and what questions do you have for us after watching this series? Just a reminder, nothing in this video is financial advice, and this is just intended for entertainment purposes. If you want to read our full guide to investing, check out the links below, and make sure to watch our book reviews covering our lessons from some of the best books on business and life. See you all next time. If you don't have access to a 401k plan, an IRA, either traditional or Roth, represents your best tool for retirement savings, so contribute up to the limit if you can. So why would someone want to contribute to an IRA instead of solely sticking with a 401k?